My name is Gabby McSweeney and I'm the Head of Brand and Communications at Codat. And welcome to the first edition of Codat's community session. Today, we're going to be tackling the subject of how lenders can use data and technology to get ahead in a downturn. And the aim of today is really to bring together a group of Codat's clients, Dancerace's clients, and partners to explore a topic that is front of mind for all of us right now. We'll use the first 30 minutes of the session today to go through Q&A with our lovely panelists. And then we are going to go into an optional product deep dive. So if you want at that stage, you can drop off. But for those who want to stay, Ed, who's on the line, will be taking us through how you can use Codat's API to tackle some of the themes and the points raised today. We want this to be an informal session where you can take away some practical tips. Let's kick things off then, and would love to start with an introduction to our two panelists today. I'll hand over to Elliot firstly to introduce yourself.
Hello everyone. I'm Elliot. I'm the CEO of Dancerace. At Dancerace, we provide a complete connected ABL operating system for those who don't know. We work with banks and independent lenders worldwide. To sort of give some context as to why we're having this conversation, our systems cover the full stages around the funding lifecycle. And we've worked with Codat for many years now to provide the data extraction product, their data extraction product into our ecosystem. And that ranges from client onboarding, in-life funding, and risk management. So that's me, and that's Dancerace.
Thank you very much, Elliot. And Ed, if you could maybe just introduce yourselves to our audience today.
Thank you, Gabby. Thank you, Elliot. I'm Ed Sherrington. I'm head of products for what we call the Risk and Insight Group here at Codat, which includes all of our lending products. I think everyone's familiar with Codat, but in a nutshell, what we do in the risk group is we combine and enrich data from our standardized integrations to make it even more useful for lending use cases. So yes, very, very happy to be here. Excited to chat about all things data and risk.
Well, thank you both for joining us. And before we kick into our themes today, I'm just going to start by giving a bit of context on where we are. So everyone listening to this webinar, or the vast majority of people, will be involved in building financial products for small businesses. And I'm sure everyone will agree that it's not an easy time to be running a business. It's probably more difficult than usual. Small businesses are being squeezed on both sides. Rising costs make it more expensive to run their business, but at the same time, revenues are taking a hit as customers are having less disposable income. And so for lenders, this presents both a risk and an opportunity. More small businesses need support to manage working capital pressures. But on the other hand, many small businesses won't survive this downturn. And so there's a greater risk of defaults to those who are lending to. And alongside this, as central banks are seeking to curb inflation through interest rate hikes, capital is becoming more expensive, both for those accessing capital, so the small businesses, but also for non-bank lenders who will need to raise capital to lend out. So today we're going to have a look specifically about how data and technology can help to ease some of those challenges facing lenders, hopefully find some reason for optimism in there. And our first theme of today is about how we can use data and technology to mitigate risk specifically. Elliot, in your view, how can lenders use data and technologies to better safeguard against the risk of default in an economic downturn?
Okay, very interesting topic. And obviously anything I do say is not necessarily guaranteed to prevent these sorts of things. But what we're seeing across our customers and in the marketplace generally is that people are investing heavily into their management information dashboards, or they're getting better reporting. And what that can do, if you're reporting regularly enough, is that can give you a really, really interesting insight on the pulse of your business for either the money you're lending or the clients that are borrowing funds from you. So what we've seen also is that whilst in the past people were looking at weekly or monthly insights of data, so building these MI packs, we're now seeing businesses able to produce daily or even hourly MI information that really do help them make decisions either in sort of real time or just good, as good as. So building up the access to data, so accessing more sources, or just using the data that you've already got in a more responsive way. That's a really great way of understanding what's going on. Yeah, I mean, the only challenge then is if you do have a lot of that information, what do you do with it? And we can, I think we can talk a little bit more about that a bit later on, but there is a bit of a challenge when you do have then too much data too often. You then need to sort of make sense of the noise. But I think more rapid access in higher frequency is something I think will massively help lenders.
Fantastic. So really getting more data in to look at and make those decisions and monitor the existing portfolio is kind of the first step in your view. How about you, Ed? What's your take on using data to better manage risk?
A lot of overlap, I think, with what Elliot said. Typically, when we in Codat are thinking about developing products for sort of risk reduction in the credit space, we bucket into 3 factors: timeliness, detail, and accuracy. So that first one, I think a lot of what Elliot's saying resonates. In turbulent times, there's more uncertainty than ever. How can we enable lenders to make decisions based on the freshest data available? That's something we think about a lot, but as well as that, enable them to continue to use that data post decisioning, proactively monitoring and shorter timescales so that they can react in as close to real time as possible and apply really targeted mitigations against any indicators of financial distress. So that could be pretty extreme: early repayment, loan termination. But what some of the more interesting things that we're seeing from our client base, I think, are more productive, sort of trying to help borrowers navigate tough times. And if you have early enough insight, you can use that insight to give them actionable recommendations, whether that's, you've got your trade receivable days are too high, maybe you could chase some invoices or whatever it is, like adjust your terms. You've got a lot of inventory on hand, maybe you should consider that as a sort of key point of information, that sort of stuff. The second bucket, detail, like traditional techniques for spreading and ratio analysis, of course, like will always have their place and are unbelievably valuable. But I think modern technology enables lenders to look at more specific indicators of risk that may be present in a business's software stack. So some examples might be reviewing bank overdraft utilization rates from bank data in near real time as an indicator of financial performance in accounts. If there's a sudden contraction in someone's payroll account, maybe they've had some sort of redundancy as a part of their business that warrants further investigation. So there's lots of sort of interesting bits of information that previously you wouldn't have had access to that you can use in isolation to inform decisioning, or as an aggregate as inputs to sort of machine learning based risk models. So it's something we think about a lot. And then just the third one, accuracy. So how can we improve a lender's confidence that the data that they're using for decisions and for monitoring is a true and accurate representation of a small business's activity? We can cross-reference different data types to ensure that there's no misrepresentation. You can do really interesting things around analyzing ledger activity if we're talking about management accounts to spot indicators of fraud. One of my favorite ones, which is a little bit nerdy, so I won't go too deep into it at the risk of turning everyone off, but Benford's law is this statistical observation that says, in a large numerical data set, the first digit after a decimal point will be 30% of the time. And then there are different sort of variations and different numbers there. And if you apply that knowledge to a big data set programmatically, immediately, you can quickly get a sense of whether it's likely to be, an accurate representation of business activity or whether it's just made up numbers. So lots of interesting things you can do.
Fantastic. Lots to take in there, Ed. I think so. To summarize, you said the 3 points that we're looking for are timeliness and accuracy, and also the amount of detail of the data, 3 things to look for. We've got a question here that's come in, which is really wanting to dive in a bit more to that management information for lenders and kind of making sense of data. And it's specifically about Dancerace's product. How do you tackle that within Dancerace? Do you offer lenders that kind of dashboard to review information?
Yeah. I mean, what we are doing with data is that on our actual back office platform, we give as much concise and relevant information as we possibly can in real time. So, but since the inception of the product, it's always been about providing real-time data. So that's obviously helping to address your operational requirements. But what we're doing also is when we do collect data from sources like Codat, we're then actually structuring it and standardizing that information in a really lender-friendly way. We don't want it to just be overwhelming, or that you have to trawl through information to try and make sense of anything. We actually make it exceptionally relevant for receivables finance or asset-based lending products specifically. So again, that's that kind of consolidation. But what we're also doing, and there's always been a policy we've upheld, is that we make all of the data available to our clients, either through reports you can access in the system, or a data warehouse solution, or now our APIs. So any data that's coming in from our Codat feed, for example, you can actually also extract via an API, so that it can go then either in the raw format that we get from Codat, or in the post-transformed format that we then apply to maybe a sales ledger analysis or purchase ledger. So yeah, we really think that complete suite does kind of give you that immediacy that I was referring to. Although you've got to know what to do with it if you want it out of your system, but if you use it in our system, then obviously it's structured and helpful.
And so looking ahead, just kind of wrapping up this first theme, as technology continues to evolve, maybe you could just give us a couple of specific opportunities that you see on the horizon for further mitigation of risk. And Ed, maybe if you give a few thoughts from your side.
Yeah, sure. So one thing we're really excited about at Codat is proper SMB-focused bank transaction categorization that can enable a lender to effectively rebuild a financial statement out of bank data. I think that's something that can be really, really exciting in terms of providing a cash-based view of finances, but also increasing trust on that third theme in the previous my previous answer. Categorization of bank data has been around a long time. A lot of people listening have probably seen it in their bank apps, Monzo, et cetera. But retail consumer categorization is a totally different kettle of fish. SMB bank transaction categorization is much, much harder. And the categories, of course, will be very different. Like, it's less helpful to an SMB lender to have things grouped by coffee or entertainment or whatever it is. It's much harder to categorize because SMB business activity, SMB purchases, income, it's much more subjective. So if Codat goes and buys flowers to decorate our meeting rooms, that's going to be an expense. But if a florist buys flowers, that's actually slightly different. It's a cost of sale. It probably has an entry and as inventory as under assets on their balance sheet. And I mean, there are lots of examples of this which are really challenging. Another one, payments to people. Is it an employee, or are they in the hospitality space where actually they rely on contractors? So again, it's a cost of sale. So it's a really, really challenging space, but one I think that's going to bear a lot of fruits. And we've been taking amazing strides in this area. So yeah, something I'm really, really excited about for risk mitigation.
And how about you, Elliot?
Well, I mean, actually, we are on the cusp of launching a new risk product called R3, and the whole principle around that product is to focus on data analysis in an exception basis. So we'll do all the hard work with the technology to trawl through the information, and then essentially let you know when something has been breached, or there's been some sort of scenario in which it is an indicator of risk. And rather than you essentially having to apply expert knowledge, whilst going through large amounts of data. So we're trying to consolidate all this information across all of our systems, including Codat, including our back office system, C3, and then really make a concise and quick to access view of it all in one place. So that's what we're trying to do that's what we're
sounds like it could vastly cut down the human time required to sort through that data and kind of get to the crux of where the issue might be.
Absolutely. And if you can then put in your expert knowledge to create those rule sets initially, and then let the system actually check the data to see if they fit with those rules. And then, then you just get the result, which is what you're looking for, the most risky client.
Well, I'll move us on now to our second theme of today, which is taking us in a bit of a different direction in terms of moving away from mitigating risk and more thinking about, in this environment, how can lenders use data and technology to operate more efficiently, and think as well about reducing costs with data and technology. So I'll put the question to Ed in the first instance. What's your perspective on this?
Yeah, I think it's a really sort of important and timely question. I think we've certainly seen a shift in the broader market from clients and prospects wanting to use Codat data to originate more loans, grow their book, to maybe more of an emphasis on risk reduction and cost reduction and efficiencies. So a really timely question. I think there's most of the time there's lots you can do with respect to kind of direct efficiencies that can be made to reduce, not necessarily eliminate, but reduce human intervention, the sorts that Elliot's just been talking about. These can be enabling automatic ratio calculation using the categorized data I mentioned, having guardrails in place that, as Elliot talked about, Dancerace do, to enable you to sort of really quickly take actions on the back of that data. I think some of the really interesting operational efficiencies that you can achieve with data relate to there's more niche steps in an underwriting process. One I was working on with some of our team the other day is around invoice finance, where if you're an invoice finance provider, you have to validate open invoices that a borrower has submitted to you for funding. You need to validate that they are actually open. If you choose to fund them, you need to validate the risk associated to the counterparty to those invoices. Has the customer historically paid in full and on time? And oftentimes that's a pretty manual process because you're having to go through and check accounts receivable data against bank statements and look for either the presence or absence of payment data relating to those invoices. Something, of course, that data can help with. We can automate that process. We have models that can match, cross-reference those data types and highlight where there is a payment that shouldn't be there, or where there is a lack of a payment that perhaps should be there. So lots you can do around direct efficiencies like that. And then also indirect efficiencies, using data to qualify loan applicants upfront so that you're spending less time on borrower or applications that are ultimately going to be unsuccessful. You can do that really quickly with access to data.
Fantastic. And that point on checking transactions, verifying invoices sounds like something that you'd be very familiar with as well, Elliot. Is there anything that you'd add to Ed's points on there, and in terms of kind of using data to be more efficient?
I'll take a slightly different look to this, in that actually efficiency is pretty much, it's largely what I spend my life doing, is trying to make what is quite a convoluted process in receivables financing, our background, into something that's a little bit easier to operate. Because in terms of the risk, if you spend 90% of your time just dealing with the operational processing of information, you're not really spending a lot of time focusing on the information itself. And so what I see here is getting that access to data through really good technology actually reduces risk, because you can spend more time assessing the information itself. So if you make one thing more efficient, you actually are more efficient at the thing you're trying to solve and prevent. And I think that, we've seen a lot of businesses or fintech companies trying to oversimplify it. And then actually, as soon as things start getting complicated, the risk goes through the roof, and you wonder why, because actually technology isn't just the solution, isn't the solution to everything. It can make things easier, but then if the people on the other end of it are, and then not enabled to kind of add additional value, then it's not helping. So yeah, it's an interesting topic, and efficiencies I could talk all day about, because there's so much you can do with data, but also just through really easy to use technology as well. It's not just about the information. yeah.
And it sounds like what you're saying. It really reminds me of the kind of AI debate right now about, you know, augmentation of the people you have, rather than you know, taking the people out of the equation, just taking away the boring task and allowing them to do more of that high value work.
Yeah. I agree. And I think that AI is going to be very interesting in that it will start asking questions that we don't typically think to ask, or it will ask insightful questions based on information we didn't think was relevant. And I think that's going to be very helpful. But no, I agree. It's there to help, not to replace.
Fantastic. And so we've got a really interesting question here in the chat as well, just before we'll answer this briefly before we move on to our third and final topic of today. So someone in the chat has asked, we found that one way of reducing risk has been looking at multiple sources and cross-referencing accounting data with commerce data. How can this be further automated? Or maybe I'll put that to Ed.
Yeah, that's a great question, and we are, you know, equally super excited by the potential of cross-referencing different types of data. So we have a data integrity product that does that, albeit not with accounting and commerce data yet. It's focused on accounting and banking data first and foremost. But I think that typically there are benefits to different sources of information that are slightly different. So, you know, accounting data, incredibly rich in context, but not always timely, maybe not always reliable because it's sort of mutable. Bank data, immutable but low in context. Sales data, really rich in terms of basket level information, but not always a holistic picture of a business's activity, particularly in this omni-channel world. You're going to get the best understanding of a business's activities and therefore their risk profile if you can get the best of all of those sources of information. So there's lots we can do in terms of further automating it using the data that we standardize from commerce subscription payments platforms and running it through our data integrity models to cross-reference it against corresponding entries in different systems. And I think
I was just going to say, this sounds like a really interesting one from a direct conversation with the Codat product team as well. So maybe a really interesting one if you are a current Codat client to pick up with your account manager after this, and maybe we'd love to hear some more information about specifically what you'd be looking for on that point. So we've got 5 minutes left of the Q&A part of today. So I'm going to move us on to our final theme of the day, which is about using technology and data to identify new opportunities. So coming back to Elliot on this, new opportunities is fairly broad, but maybe if you could specifically comment on new opportunities in terms of new customers, but also how can you add more value to existing customers using technology?
Yeah, I mean, I as I said before, we come from a receivables background, but we're, when expanding out to other types of lending, we can see that accessing data and insights into a company's accounting system as being hugely helpful in assessing whether or not they have other funding needs. If you can, provide an invoice discounting product, but then through the fact that you can see their management account information, notice that they have a requirement for a loan, or they might have assets on their balance sheet that you could refinance, you could actually provide that insight back to the customer and offer additional products on top of their basic product they have with you. I think that additional value that can be brought will create stickier customers, but also expand the market, because a lot of businesses don't necessarily know what products they're looking for. They actually just know they need money. And so it is incumbent on the lender to make the recommendation to the customer as to what kind of product suits them as a business. And I think by just exposing their financial data, you can actually get access to that kind of insight and give that kind of advice. And then in the ideal world, if all of the operational overhead disappears entirely into this sort of Shangri-La, then your team can become really, really insightful advisors to customers, and actually almost start advertising to businesses who don't have any idea about whether or not they need lending at all, but just getting access to their data could give them a lot of value.
So it sounds like that's the benefit there is really threefold. You know, you're enabling, the data is enabling you to cross-sell, but also make your clients or customers benefit that perceived value from the advice, as well as making them stickier and making you more likely to retain them.
Absolutely.
How about from your side, Ed? Is there anything else that you've experienced with Codat clients or trends that you're seeing of how clients are using data to identify new opportunities?
Yes, definitely. And, you know, it's an exciting position to be in, seeing our innovative clients, give cause for optimism amongst the sort of barrage of gloomy news from the financial news cycle. But I was going to channel Marissa Mayer, the former CEO of Yahoo, who said innovation is born from the interaction between constraint and vision. I think the constraints are obvious for lenders today in terms of cost of capital. You can't differentiate on price and things like that, but it's really inspiring to see people have the vision to differentiate in other ways. As Elliot sort of paid tribute to, lenders have this really privileged relationship with their customers, one built on trust, but one where they have a lot of insight into that lender's business, and you can use that to provide innovative loan products. Something that we see a lot of is sort of smaller, tighter, faster loans that are tied specifically to purposes, which can help the borrower by making them feel and be less kind of on the hook. And is beneficial to the lender because obviously there's less sort of transaction level risk, and if it comes to it, they can rebalance their portfolio easier because the loan cycle is shorter. So lots of innovation around those sorts of micro loans. And then outside of kind of core lending, we're seeing a few clients start to focus on sort of adjacent tech-enabled value-added services. That's the most buzzwordy phrase I've ever said. But things like cash flow forecasting services or dashboards, or these CFO as a service type offerings, which are really, really complementary to loans, often go hand in hand with credit provision, but are enabled by this sort of unique position. Understanding loan service requirements, understanding a business's performance, having access to their data. I think that we'll see a lot of innovation, and already are seeing a lot of innovation there.
We're going to spend the next 10 minutes or so going into a bit of a deep dive of Codat and looking at how our clients can use Codat to tackle some of the issues that we've discussed today. So I will hand back over to Ed to share more on that.
Thank you, Gabby. And I guess I don't want to raise expectations too much in terms of the depth of the deep dive. Like, we've tried to keep it relatively high level here, just to serve as a sort of platform for people to understand how they can perform some of the tasks we talked about using Codat's product suite. And if you are interested in any particular bit, please do reach out to your account manager, reach out to Gabby, myself, anyone, and we can talk further. I thought it would be best to frame it in terms of these sort of jobs to be done, these sorts of goals that lenders often have when they're using Codat. The first one, which we mentioned a lot, particularly in the efficiency section, is around building ratios and metrics with Codat. What can you do to augment the decisioning process when it comes to that piece? A lot of our clients use financial ratios, traditional financial ratios, and they've built them on top of our enhanced financials products. So this is something that we've done in response to the fact that when you are retrieving financial statement data from borrowers, there's like additional levels of normalization that you will typically need to do because borrowers will name their accounts in very different ways. So as a sort of potentially a little bit trite example, you might have someone call their marketing account marketing. Others might call it sales and marketing, or ads and marketing, or AdWords, or Facebook, or something totally bananas. And it makes it very difficult to programmatically create ratios, do calculations off the back of that data. What we do is we have a series of models that will categorize accounts according to a sort of predetermined set of schema, so that you can then create those ratios automatically. You could just about see on the screen like what the JSON looks like, but I guess the high level points here is that it's a really comprehensive SMB focused category schema. It has 5 levels of detail, ranging from L1 being the basic income, expense, asset, liability, equity, right the way through to a low level of detail at L5. So for example, you might have a gas bill come as expense L1, and then L2 operating expense, L3 utility, L4 energy, L5 gas, and each level comes with a confidence score, so you can build rules off the back of that depending on your risk appetite. Some of the more specific risk indicators that I talked about in the Gabby's first question on risk and using key data or individual data points to as an indicator of financial difficulty. You can get these in our standardized integration. So there's some examples on the screen here of risk indicators from accounting data sets, from banking data sets, and from commerce data sets, to things like invoice dilution, overdraft utilization we mentioned, MRR from subscription platforms, refund, chargeback rates, all that sort of stuff you can create using the standardized data that we have at Codat. And if you want sort of guidance on how to do that, best practices in terms of creating those ratios and metrics using Codat, please do reach out. It's something that we have available and that we'd love to work with you on. If you don't mind popping to the next slide, Gabby, I'll just whiz through. I actually mentioned this, so a bit of a spoiler alert already, but something that we're very excited about is enabling people to build a kind of cash flow statement using Codat data. Useful, of course. It enables a really reliable assessment of liquidity in service of proper sort of affordability assessment. So you can use the financial statements to understand sort of financial strength, profitability, but then you really want to understand a cash-based view to really to reflect a business's affordability for a particular loan product. And this is something that people in the market are doing more of. We're really bullish on our ability to perform this because of our kind of secret weapon, which is access to accounting data alongside bank data. So our models are trained not only with the inputs that you have available from bank transactions, transaction descriptions, and related fields, but we also cross-reference that against account transaction equivalents, so accounting data, to create a really powerful and model that can enrich what is, I don't know if people on the call have interacted with sort of raw bank data, but it lacks context, and these models can enrich it to the point where you can, as the graphic shows, start to reconstruct a really sort of accurate cash flow report and use that for decisioning. So yeah, we're really excited about this. If you're interested in this, please do reach out. Yeah, we'd love to chat further on it. And then finally, a little bit conscious of time, one thing we discussed as well, evaluating accuracy of data with Codat. It's something that we've spent a lot of time on with certain clients who, particularly if they're using management account information, as Elliot said, like bringing it into dashboards and the like. In some areas, there are requirements to have a degree of confidence around the data that you're decisioning on. How can we lift that trust to the level of sort of audited financials? And we do that through someone in the questions had the great observation around cross-referencing different data types. I promise they weren't a mole. Cross-referencing different data types to get the benefit of context from accounting data, but immutability and trust from bank data. Our data integrity tool has been something that people have responded really well to, enables you to do that programmatically. And then the audit report is something I decided to include. I hope it's of interest to some people. It is actually only available via Excel at the moment, so you can download an Excel report. But if it's of interest, please reach out. What it does is highlight any kind of indicators that a set of accounts might be either inaccurate or out of date. So things like P&L trends, it will highlight where there are things that are out of kilter with the broader set of accounts, outliers that might be worthy of investigation, dates that accounts were last updated, indications of how many sort of round sum values or blank descriptions, some of those things that might be indicators of fraudulent activity are in large data sets that you know, to a human underwriter or credit analyst would take a little bit of time to do. So it's trying to bring a level of data focus to that kind of auditing role.